Good evening, I'm Richard Gonclaves. Welcome to the Thursday edition of Market Moves. Roger Montgomery from rogermontgomery.com joined us now in the studio to tell us exactly what moved the markets. The market's been little moved lately. Why so?
Well, look, I've been saying, for some weeks now to you, Richard, that I think the market's fully priced. I think it's a little bit overvalued, and when I say a little bit overvalued, compared to my valuations, about 10 or 15%. But of course, there's 3,000 funds in Australia chasing 2,000 stocks, and so that just means that there's generally the general sort of equilibrium of the market's going to be above my fair value anyway. So it's a little bit more than that now. Having said that, that seems to be just marking time to see whether or not revenue. I think the price of the market today is looking out at the value in about 18 months' time.
Okay.
So if revenues and profits come through as analysts are expecting, and most of the, when I look at EPS, earnings per share expectations and dividend per share expectations, it does look as though, that it all looks like a hockey stick. So all the expectations are that things are going to go well. If that happens, then we might even see the market move ahead, but it seems to be marking time.
You partially answered my question, but I want to show you my favourite chart if we can for now. This is what the market's doing at the moment, and it's kind of bouncing between those two red lines for the past few months, bouncing from 4,500 to 4,900. Yes. What will it take, do you reckon, for the market to either break above 4,900 or break below 4,500?
Look, I think that what we need to see is, for it to go above, we now need to see earnings to exceed expectations in the full year results. So when those full year results come out, if we can actually see that the earnings for the last 6 months have been stronger than what even the most optimistic analysts are expecting, then you'll see another re-rating upwards. And we'll see shares go ahead. But at the moment, as I said before, that ASX S&P 200 chart, it's a good 600 points, 700 points above what I think is the intrinsic value of the market at the moment. So I think that's why it's marking time.
Okay. Just before we take a look at some stocks specifically, just when you thought we stopped hearing about the European problems, out comes Portugal. It's got nothing to do with my family, their Portuguese debt concerns.
Your family's debt concerns aren't a big concern.
No, and they don't really rule Portugal. But anyway, the Portuguese credit ratings have been downgraded. Sure. How serious, not just Portugal, how serious are these concerns coming from the European continent right now?
We're going to keep hearing these for a long, long time. I'm not going to say I'm willing to eat my shirt on the show if it happened, but I think governments around the world are going to pull all stops to prevent a default. Right. It would be such a blow to confidence. It would undermine all the pump priming that's been going on, all the trillions of dollars that have been injected into the economy. To have a sovereign default would just reduce all of that work to significantly less. And so I think all stops will be pulled to actually prevent that from happening. If it's going to happen, it's going to happen in Europe, because you've got this sort of artifice around the euro, around the currency, where everyone's economy is in different shapes. Various states of recession generally, but in different states. And so if it's going to happen, it's going to happen there, where there's not as much unity. But I would be very, very surprised if we do get a default. I think there'll be a lot of talk about it. I think economists will stare at their navels for months and months and months and wonder if it's going to happen. But I'd be surprised. It just seems to go against all the efforts that we've seen over the last year and a half.
We're always talking about iron ore pricing. Sure. I think most brokers would agree somewhere between 60%. Now, these guys go from 60%, hey, we're now expecting 90%. I don't know how closely you follow it, but what are you expecting?
Look, I as you know, follow the intrinsic values of companies very, very closely. So if everyone wants to grab a pen, they can write down these valuations. They changed materially from when we spoke last. Now, the share prices have moved a little bit, but the valuations have moved a lot more. Okay. And I think I said to you previously that I thought they were about fair value now, but a little bit expensive, just a touch. Now that changes tremendously. RIO, for example, is trading at, what have I got here, about $78.20. Does that sound about right? I've got $91 for the current valuation, $109 for 2011 and $110 for 2012.
So that changes because of the iron ore price forecast?
Exactly. Okay. If you put those iron ore forecasts, if they actually happen, then the impact on revenue, the impact on profit is such that it's going to increase the intrinsic value of the company. And then if I have a look at BHP, same story again, currently trading about $43 or thereabouts. And I should make the point, I'm not looking at the prices every day. I'm interested in the values. I'm not so interested in the prices. What I'm interested in is when prices significantly below value. So BHP, current value $37 or thereabouts, a little bit less. But 2011 it jumps to $64, and 2012 my value goes up to $72 or $71.60. So material impact on the intrinsic values of these companies. If Jim Chanos is wrong, and there isn't a property bubble explosion in China, that would be a speed hump on China's growth story. Notwithstanding that, and you shouldn't invest on speculation of that, these are the intrinsic values as they stand today.
Okay, let's move on, though, to one of our stories of the day, or issues of the day. Government numbers show that spending on healthcare is expected to nearly double as a proportion of GDP over the next 40 years. And with fewer babies being born and people living longer, it's inevitable that the population is ageing. So what are the investment opportunities? It's a bit of a topic that, Rogers, you've been following. Yes. Maybe before we talk about investor opportunities, if we talk about what's happening with this ageing population, what kind of statistics we've got to back it up to show just how old Australians are getting.
Sure. Well, if you think about it in terms of what the government is going to need to spend on Medicare and on the pharmaceutical benefits scheme, I took some numbers from the Treasury Department's GDP forecasts for up to 2040, and then I also had a look at what their expectations were for the proportion of GDP that's going to be spent on Medicare and the PBS, and what I found is about $38 billion in 2040 will be spent on Medicare, $38 billion, and 68, almost $70 billion is going to be spent subsidising drugs for people. Now, that is an enormous amount of money compared to what's being spent today, and that tells me that if you can find a good quality business that's in that space, then the thematics are very, very good.
Okay, so viewers would have heard you say good quality business. Who are they?
Well, look, there's without a shadow of doubt in the entire healthcare sector, the two standout companies in terms of quality, if you like, my A1 businesses, Cochlear and CSL. Right. They're not only exposed, of course, to the Australian ageing population, but the Western world's ageing population, including the United States. Now, Cochlear is a little bit expensive, and that's to be expected given that generally over the last 10 years it's been expensive compared to its intrinsic value, and there's only been rare opportunities to buy it below its value. But its intrinsic value, which is currently $49.68, and its price today is about almost $71, goes to, in 2 years' time, about $63. So it's above the intrinsic value of 2 years out. So it's a little bit expensive, which is disappointing because it is a great story. It's a great company. It's one of the, I think, the best quality businesses in Australia. CSL is a similar story, a little bit expensive compared to its value, but an A1 business. And if you ever got the opportunity to buy it cheap because people lost confidence in it temporarily, we saw that recently. A lot of analysts, and this is an interesting thing for investors to think about, analysts were saying only a year ago or 8 months ago that CSL's no good, it's got exposure to the US dollar, you know, and that's a problem. Now when you read analyst reports, they say, well, let's look through the US dollar exposure. What a great business. And nothing's really changed other than their perception has changed. You can't predict that, so always buy good businesses when they're offered cheap, and CSL was cheap a little while ago, a little bit expensive now.
So you mentioned two larger businesses, though. Anything on the smaller scale?
Yeah, look, I've got Certex. Certex is another A1 rated business, but unfortunately, compared to its value for, well, actually, no, 2000, look, its value today is $5.36. It's trading at $6.12 or thereabouts, and its value next year looks like it's going to around $9. But of course, don't use that as, don't make that your signal to go and buy the stock. You need to go and do your own research, and these valuations are reliant on either the company's forecasts about what it's going to do or the analyst's expectations for what it's going to do. But again, another business in the right space, great quality, and its intrinsic value is rising.